Hello dear traders, you are watching a recap of the Asian session. Why are stock markets rising and why is the yen losing momentum? What bolstered the dazzling rally of the US dollar and the Aussie? Watch our video review and find out the answers. The US stock market advanced on Monday. The S&P 500 index has been growing for the third consecutive session. The equity market went up yesterday, mainly thanks to tech stocks. Apart from that, bullish sentiment is strong amid upbeat macroeconomic reports and the upcoming talks between Russia and Ukraine. It seems that hope for an improvement in the geopolitical situation eclipsed the forecast for an aggressive interest rate increase. Wall Street investors did not pay much attention to the Fed's monetary policy plans yesterday. However, forex traders did take notice. As a result, the US dollar keeps rising amid expectations of another rate hike. What's more, it's trading with a bullish bias as a safe haven asset. The bond market also facilitates its growth. The 10-year government bond yields has already jumped by 2.5% this week, and today the US dollar index is trading at 98.99. It's likely to stay in the range of 98.90 and 99.29. In addition, the greenback takes advantage of the weak euro. The European economy is bearing the brunt of high commodity prices. The likelihood that the ECB could raise the key rate is extremely low. Unlike the Fed, it needs to take more cautious steps. And this is why analysts are betting on a further drop in the euro. It's always bullish for the US dollar as the share of the euro in the basket of main rivals accounts for 57%. After a 4-day rally, the US dollar approached its 2-year high. It remains to be seen whether the greenback will be able to maintain its rise during the Asian session. The US dollar also hit a yearly high against the yen. Currently, the dollar-yen pair is trading at 123.56. hovering in the range of 123.08 and 124.30. Analysts believe that the price could climb to 125.86, a high of June 2015. It's always good when a national currency is trading steadily. However, the Bank of Japan is dealing with a rise in import costs due to the weaker yen and the geopolitical crisis, and this is why it has no time to focus entirely on the yen. The regulator is also unlikely to change the parameters of the monetary policy, even if the yen drops even lower. For this reason, bullish forecasts for the yen are getting irrelevant, especially after yesterday's unprecedented step taken by the Bank of Japan. It made 2 offers in a single day to buy an unlimited amount of the 10-year government bonds to defend its 0.25% yield cap. The Bank of Japan is unwilling to abandon its ultra-loose monetary policy. Bank of Japan Governor Haruhiko Kuroda considers the weakening of the yen as a positive factor for the country's economy. And this is why the yen is highly likely to hit new lows, largely because of the interest rate gap with the United States. The Australian stock soared to the January highs following yesterday's rise on Wall Street. The recovery of the tech shares outweighed the losses of the commodities sector. Market participants expect the Reserve Bank of Australia to hike the key rate. However, the last Reserve Bank of Australia meeting minutes showed that the watchdog considers the geopolitical conflict in Europe to be the main factor of uncertainty. And this is why it sticks to cautious approach, carefully monitoring how it affects inflation in the country. While the Reserve Bank of Australia is sitting on the sidelines, the Aussie is gaining momentum amid the high commodity prices. It's hardly surprising given that Australia is a net exporter of energy commodities and other raw materials. The Australian dollar has already risen by more than 7% above its 2022 low. It was trading at 0.7502 in the early morning. During the Asian session, the AUD-USD pair maintains its upward movement, fluctuating at the support level of 0.7476 and the resistance level of 0.7518. And that's all for now. Subscribe to our channel and stay up to date with the latest market news. Feel free to leave your feedback and see you soon.